Mr. Keller, how are you, sir?
I'm very well, Mr. Gordon. How are you?
Not bad, not bad. I'm coming over your neck of the woods soon. What's the weather
Excellent.
like? I need to check the important things first. Weather first, markets next.
It's like the market. It's heating up, heating up.
Good,
It's
good.
beautiful. Although I was up in Northern Territory last week, and that was a little bit too hot. But Sydney's beautiful.
Sydney's beautiful. Well, look, it's been a while since we caught up, and obviously the market has. We're talking uranium, and we're talking nuclear as well. I think, and just trying to understand from an investor's point of view, what's happening. So, I mean, how would you characterize the Aussie market compared to, say, the North American market?
Yeah, I mean it's the Aussie market is underwhelming compared to North America and uranium. I mean, there's obviously been a few company-specific hiccups that have sort of derailed some progress there in ramping up projects. But it still feels like it's a tough sell down here to get investors, in on the trade. And a lot of investors are also worried about liquidity to get in on these trades. You contrast that in North America, where we're seeing hundreds of millions of dollars raised by converts or equity into a bunch of these companies, and there's a much more sense of urgency to get on the trade. Whereas, I mean, in the last few days, obviously the uranium stocks down here have run, but it just doesn't feel like there's a belief that this is going to continue in this part of the world anyway.
Okay, that's kind of interesting. And because I think obviously you had elections, was it earlier this year, end of last year?
Mhm.
And I think expectations were that you might get a slightly more nuclear friendly party in place, well, everywhere but Western Australia, I think. That didn't happen. Does that sort of change the conversation in terms of, nuclear's role as a sort of, baseload, grid stability, decarbonisation goal conversation? Or is it just there are more important things like gold happening?
I mean, I think the public perception around investment opportunity in uranium is kind of separate to nuclear. Um, there's unfortunately, the federal government here is gearing up for the long-awaited meeting of the Prime Minister of Australia with the President of the United States after 40,000 failed attempts on the Aussies' behalf. And there's a lot of push to obviously critical minerals are high on the agenda as something Australia can perhaps bargain with the US. And there's a push that uranium should be included in that conversation. And yes, I understand that the strict definition of a critical mineral does not include uranium because it's an energy metal. However, the political opposition to nuclear power seems to be standing in the way of including that, and also seems to be an excuse on the state level again around uranium. Although we're starting to see a little bit more activity in Western Australia with a few deals recently. ISO taking over Toro and Orpheus picking up some Ubaguma in Western Australia. So there seems to be a few more people thinking things may change in Western Australia, but we'll see.
Not Chris Bowen, that's for sure.
No, no, he's still hitched his van permanently to the solar China Inc. solar and wind turbines.
Right. Okay. So energy security, not really sort of top of the agenda at the moment. So what does that do for funds like yourself? I mean, how do you view the landscape and how do you react?
Well, I mean, the great differentiator I have is that I'm a global investment in the nuclear and uranium thematic. So, if there's a period here where the ASX is not interesting, there's certainly plenty of interest in uranium in North America and, more importantly, nuclear. So one of the big changes in my fund in the last sort of few months, which kind of started May last year, but in a small May 24, but in a smaller respect, was the inclusion of what I call nuclear innovation into the portfolio, and now more than half of or around half of the fund is in nuclear innovation. So taking away that uranium commodity price risk and taking advantage of the billions of dollars trading in some of these names in North America on the back of data companies, data centers, tech companies, the desire for baseload electrons, especially in the United States.
So how are you viewing this new technology? Because I think you're right. A lot of the conversation I think at WNA was the fact that you had people like Microsoft, the technology companies are coming out to play and certainly
Yeah,
looking at things, but that's a long way from them actually doing anything at the moment. One could argue, maybe the US government could also step up a bit. But when you're looking at these investment opportunities, around enrichment, etc., what do you look for? Is this based on where they're gonna insert themselves into the energy supply mix? Is it based on purely on the technology, and we'll worry about efficiencies and we'll worry about the kind of cost per kilowatt or economies of scale? And because it feels to me like this space has been predicated on what could be. If uranium price goes to $200, our problems are solved. If the demand will be there, rather than based on what's actually happening today and the speed at which all of that can move. So
yeah. Look. I think the big difference is for the first time, the nuclear power sector globally has got an end customer who is price insensitive and prepared to enter into long-term commitments. So
have we? Tell me more about that, because I think I think if people are looking at spot price are going, well, Jesus H Christ, we've got utilities who are opaque and almost clandestine in nature, and they don't seem to be rushing to the table anytime soon. Price is still so $80 now, which is not bad, but it ain't the 200 promised 4 years ago.
And that's the disconnect. That's the missing sort of neuron that hasn't connected yet. Is that the utilities are getting demand for their electricity, and price certainty. So Microsoft PPA at 100 and whatever, $20 or $30 a megawatt hour for 20 years. Constellation hasn't had a customer like that for decades, and rinse repeat all over the spectrum, not just in North America, but also in Europe and coming in Asia, but not necessarily nuclear to start. So they've got that certainty, but they haven't passed any of that down into their fuel supply yet, because they're still working on a last cycle on an old world model that when we need the fuel, we'll get the fuel and it'll be available because it always has been. So at some point the penny has to drop, and I think what actually happens is those, especially the PPAs for gigawatt scale generation, the reactors that are turning back on, what have you. It's going to be the end customer, the Microsofts, the Metas, the Googles, all those guys, that are going to be turning around to these utilities and say, okay, so we've given you a 20-year deal to get 900 megawatts a year of electricity, and we're paying you more than twice the wholesale price. Have you got the fuel? What are you doing about it? Because, we've made the commitment for you to provide the electricity, but we're not convinced that you've, securing your fuel supply. Because, Russia and China, we're seeing all of that. We're seeing them rushing out and doing this. But you guys are not. So I think, again, that's the difference that hasn't. And, when you talk to these big companies, the constellations that have done these deals, and you talk to the fuel buying companies, and I say, I bet you, that you had meetings with Microsoft. The fuel buying team, I bet you they met with you when they were doing their due diligence about turning on that reactor, because they want to make sure you guys know what you're doing. They don't want to sign a multi-billion-dollar deal here at the C-suite that looks good on paper and then fall down because the fuel buyers have forgotten about the fuel. And I think that's coming, and that's going to be the big wake-up moment to these utilities, where either the tech company just, with Microsoft joining the WNA, they just bypass them and go and secure their own fuel. And say, you know what, we've gone, why wouldn't they? They do lithium hedges, they've done, all sorts of hedges around battery energy system raw materials and battery electric vehicle raw materials. What's to stop them turning around saying, we don't trust you. We're going to go out and get it. We've got 20 years of uranium supply, and we've worked out conversion enrichment orders as well. Here you go, done.
Yeah, I agree with that. That's how they would think. Right? We've got all the money in the world to kind of shortcut the process and get on with it. And I'm sort of wondering what utilities are bringing to the table in a lot of ways. But there's also this sort of feeling from investors that these tech companies will come and solve the problem for all. I'm not sure that's the case. They're going to solve the problem for themselves.
Yeah.
I think they're going to be very specific of the type of energy that they want, and I think the kind of certainty that nuclear can give them in terms of energy supply versus say renewables, say even in North America, gas, because there's an infrastructure which is, let's say, called aging at best. So the technology for you looking downstream is important as an investor, as a fund. And do you think that retail should be sort of starting to pay attention to this? Because you've always, when we've had conversations, over the past few years, you guys have sort of come across as very contrarian. You're trying to kind of get ahead of the curve, trying to get in at the right price. It's going to give yourselves that upside. Is that we think maybe retail should be looking?
How do
they play it? Can they play it the way that you do? Let's put it that way.
Yeah. Well, that's part of my advantage. I'm trying to find ways that I can be invested that others can't, in order to make people invest in my fund. It's a tricky one, because almost every analyst that's trying to put some analysis around nuclear technologies is struggling to work out what that valuation should look like. And on every metric, they're screaming expensive, except that idea. And again, it's kind of a uranium idea as well, that if you truly believe that this is only the beginning, and you're prepared to wear the volatility, because it's not a trade for the faint-hearted. I mean, some of these. I mean, you look at the actual implied volatility of some of these US listed things, 120%. I mean, that's not there just as a magic number to that's actually a real number telling you that these things are moving around. But you're not trading it for valuation. You're trading it for news flow and government announcements. You're trading it for tech company announcements, and you're trading it on the basis that at some point that MOU money or LOI money or is actually going to turn into real money and real progress, and then you've got to hope like hell that that's been directed to the company that you're invested in, because you might have a wild ride. So it has been. It's taken up a lot of my time being extraordinarily active. I think I've probably been 5 to 10 times more active in managing the risk around those exposures than I have the uranium. And uranium's volatile at times as well. But just because it is so susceptible to that meme type momentum flow, and it's really hard to say at this share price X stock is cheap or value. Because how do you value it?
Well, how do you value it? Because you've got about 20 different technologies out there being tested by various governments, and everyone's trying to work out whether they go Betamax or VHS, right?
Yeah. I mean, part of the advantage, I guess, is that there's not that many listed opportunities on those technologies. So what you then tend to find is if a similar advanced nuclear technology gets a positive headline, say a TerraPower, as private Bill Gates, if that gets a positive headline, it's a private company, so you can't benefit from that. So investors then go and jump in every other listed one, thinking that so you get a little bit of benefit by the fact that there is not much of a universe. That's changing, because we're seeing, I think there's 3 or 4 SPACs at the moment with nuclear technologies coming to market. And so, you're going to get a lot more of these things like uranium. I mean, I look at some of these things that come up on social media, and it's some exploration company I've never heard of, and I've been in this space for 10 years. So you are going to get that where you start having to be much more selective, but and that will come. And to be honest, I'm actually looking forward to that because I'm doing the work in every single one of those private and public and SPAC opportunities to work out where I think I should see price appreciation as opposed to value, because as I said, it's kind of hard to value these things.
Yeah, okay. Well, so I guess I think for retail investors, in terms of that's a difficult play, and maybe they should be looking at funds like yours, because otherwise you kind of get into that world of like capping allocation to these sort of high volatility juniors that you mentioned, and we're using stop loss trailing stops on some of the more volatile exploration names. So if it's basically go and invest in this fund run by this gentleman and save yourself the stress, is what I'm saying on that front. And just on uranium, for those who like to kind of get into the uranium names, because I think if I look at the way that utilities are supposedly behaving, and you'll know more about it than me, stockpiling is what they're talking about doing. This, you mentioned it earlier, this kind of just-in-time strategy, which was, I guess plagued the market previously, as unwound during COVID. It's unwound here specifically with uranium, because people aren't producing what they thought they were going to produce and indicating to the market. So stockpiling, I think, will come back in fashion. I think the U.S. government is obviously leading from the front on that point. And what does that mean for, again, retail investors? How do they view uranium junior trades, given that none of them really, very, very few of them are producing? I can count on one hand the number. What should they be looking for? What type of profile?
Oh, that's the $1 million question at the moment, isn't it? I mean, as we've seen in other critical minerals and even base metals and things, there's been a really, really quick shift down the capital stack in the last 4 to 6 weeks, where there's been a huge amount of opportunities all popping up, and a lot of that is around US government conversations. And I think there was a delegation led by former Prime Minister Kevin Rudd into Washington, and a whole bunch of critical mineral stocks here in Australia have gone vertical just because they were in Washington. And it's kind of the same with uranium. It's like we've seen in past cycles where, it sometimes just skips that developer part of the spectrum because of all the risk. And I think it is a risk. We've seen all of those brownfields, literally every single brownfield, have a problem in restarting an idled asset with some capex and infrastructure. And now we've got a handful of greenfields, also the same price dependent. We might make a decision. You can almost sort of see investors saying, you know what, maybe I want to be in a name where they're not going to be doing anything near term, and they're going to be putting out enough news flow and promote, which doesn't solve the problem. But what do I look for in explorers? It's simple. Somebody who's doing something. I've got zero interest in giving money to an explorer who's going to push paper around on an out-of-date study, or go and kick some rocks just for to show they're doing something on the tenement. I'm looking for explorers that are saying I've got drill-ready targets, and I'm actually going to go and put a proper campaign into it. Almost saying to them, go and raise double what you're planning and hit it properly. Because I think the lifestyle company is starting to get caught out.
Oh, don't worry, it'll come back. It always does. Unfortunately, they're there. They know how to play the game. I don't like them. You don't like them, but I don't think they'll ever go away. But when do something can also mean, if I look at ISO Energy, I've got Phil Williams coming on, I think tomorrow to talk to us. They've just kind of picked up or indicated they're going to pick up Taro Energy. Taro Energy, it's not, not particularly big company. I think, beginning of, well, halfway through, sorry, this time a month ago, they're sitting at 20 Aussie, and now they're sitting at 51. People reacted well to that takeout story, it seems. M&A, that's been a strategy that uranium companies have used. Denison have used it well. UEC has used it well. And I'd even argue Encore, to a degree, has used that well, M&A. Is this a good move? Because it would, say, Taro Energy pre-ISO's announcement wasn't really sort of doing too much, was it? So what do you think of that deal?
Oh, look, I mean, I think it's a good move for ISO. I mean, Toro was with, ISO and Mega was kind of in the stable anyway. And as I said before, there's starting to be a little bit of excitement brewing that maybe Western Australia includes uranium as a green mineral, and without explicitly naming uranium, allows it to progress. And yeah, I mean, those projects in the Toro vehicle weren't being promoted or loved as much as potentially they should be. So from that perspective, it's kind of tidying up that stable a little bit. I know they looked at it a number of different ways as to what they should do with that and how that should be reflected, whether it should be an ASX vehicle with a whole bunch of other things in there, or they've obviously opted down the route of putting it into a larger cap structure. But M&A has been good at various parts in the cycle. What I'm starting to, again, the perspective we're coming from is that none of it's solving the supply deficit issue for any utility. ISO taking over Toro doesn't necessarily mean that Wiluna is going to be coming to market anytime sooner or not sooner. And it's probably the benefit of that one is they know that project fairly well. But other M&A where, you're different, completely different management team, different geos, different whatevers, taking out another company for a project, that actually puts that project back on the timeline because, are you really going to trust the study and the plan and the geology of the other team that couldn't make it work and allowed you to be in a position to take them out? No, you're going to go and run the ruler over it yourself. And that also just incidentally is the same for all of this speculation that potentially NextGen gets taken out. That to me if I was a utility, that's the last thing I'd want to see happening, because if that happens, it's going to be a major because no one else has got the ability to do that. There's not one major in the world who's going to turn around and say, oh, let's just run the plan that Lee and the team had. So that's not a 2029 or 2030 project anymore if that happens. So if I was a utility, I'd be saying, no, let the current team go on their current timeline because, that'll get pushed out. So as I said, the time of growing for the sake of growing to get an ETF weighting, I think is starting to wear thin with at least investors that have been around for a while.
Well, it's a tough one. It's a tough one because I think there are management groups that know how to play the market.
Yeah.
Right. Some nice, clever moves. They're not necessarily interested in running a company. They're interested in playing the market. And M&A is a big tool in the armory to be able to do that. It shows their kind of aggression and intent in terms of the potential scale somewhere down the line for someone to come along and maybe build this thing out. Shows I'm not seeing a lot of those people, those groups stepping forward to say, do you know what, I really fancy building something now into a market like this, into a commodity like this, which has not been very liquid, has traditionally not been very good at raising money in the last, I'm going to go, well, you pick a number, 15 years, right? Let's say 15 years. And it's still a relatively small market. So you've got to, I think I'm sort of gravitating towards the management teams who understand where the market is at the moment and still continue to build value for shareholders, which is very different from building value in terms of an operating business, right? And I think that that kind of puts them in a slightly better position for when the market does move, but they are not doing much in terms of making the market move. They're not doing much in terms of saying, well, you know, not proving up that they can actually produce, but they're talking again that they will produce. And I know, anyone in the sector knows that rather large multi-billion-dollar company is nowhere near producing. So it's just kind of smoke and mirrors a bit still, and I think that's such a shame for the space. But
Yeah.
it does give it its talk at some point because utilities are going to go, well, who do we believe?
The problem as well is that those companies that have tried to get into production, every single one of them has stumbled. And so what that's resulted in is boards and management then focusing inward and saying, we just need to get this project working. We just need to get it up and running. And so that whole broad vision of some of those teams where, they could have potentially used their platforms to go out and find, next in line projects to say, hey, look, see, our team's done this. They're all too scared to do anything. They've all lost their confidence. They've all lost their swagger. And it's literally every single one of them. You talk to any of them and say M&A, and they go, whoa, I need to focus on my project.
Well, they do because the market. No one wants people falling over, right? But we had Peninsula really struggle for a long time. Boss even sort of have had a few problems recently. It looks like they're sort of sorting themselves out again, which would be good to see. Encore, a few problems beginning of the year in terms of hitting numbers. You've got okay, UEC. Well done for the 1 tin of yellow cake. But they've kind of pushed the boat out again and said actually we're going to be getting into refining, so we're going to avoiding the need to actually deliver any yellow cake. You got Denison sort of struggling with kind of permitting, and I know they're kind of coming down to the final few yards here, but they have been since 2019. And Kamakai, and Niger. Let's not even talk about Niger. So the whole thing is just a catalogue of it ain't as easy as people think. I think the old timers have said that to you and me for a long time. People think it's easy. This is mining. It ain't mining. It's mining plus, and that must scare investors. That's going to scare big investors at some point because I believe the thesis.
Yeah.
The thesis in terms of supply demand, fantastic. Smashing out of the park on that one, boys. But every time someone struggles to actually start producing, it's not good. I don't think it's good.
Nope.
Not good.
But this is a problem.
Do you think we've reached the kind of if we reach that point of no return, where people go, oh Jesus, we got to pile in here because the thesis is so good that we're hoping technically that these boys can sort it out. Is that where we're at?
Yeah, I mean, well, it scares investors, but it's not actually scaring utilities, whereas it should be scaring utilities, and investors should be, trying to find the opportunity. But again, I guess when you say it scares investors, as I said, you look at the couple of billions of dollars that have been raised recently in uranium names in North America. One might argue that they're not scared, but then when you look at the market cap of other commodities and other energies, they are hundreds of times bigger than the global market cap of uranium. So, $1 billion of extra capital into this sector is really blip in the ocean for global resource investing.
But can I put the hypothesis forward that the new money is following bigger money? It's following the tech guys who, as a percentage of their available cash, this is soddle. This is like nothing to them.
Yeah.
They're experimenting, they're exploring, they are going to make a decision at some point. What do they do? It's following government money, which, let's be really honest about this one, if most people in government making these decisions haven't got a clue what they're really talking about. Okay, again, they need to be seen politically to do stuff. And it's something that has worked in the past, maybe it can work in the future. So I think the market is following that big money, and that money which kind of,
Yeah.
in a way, doesn't know so much. So, which is great. It's all part of the wonderful, beautiful mix of investing world that we live in, and and I think that's what we need. Need is someone to take the first step.
Yeah.
But it doesn't solve the underlying problems. Is that some of these companies haven't gone into production yet, haven't solved the problem technically yet, and maybe there's not quite as much as the WNA report says. This is technically what's capable. The reality is going to be somewhat different for 2040. Is that the opportunity, or is that the problem? I'm sort of caught in two minds at the moment. The lack of ability to supply, does that give us the torque and that kind of inflection point that we need, or does it have longer term issues where utilities are going to turn and say, do you know what's easier? Natural gas is a lot easier than this. Oil's a lot easier than this. Actually, Christ, coal might even be easier than this.
Yeah. Yes. I mean, that's an interesting one, and yeah, I mean, I guess it comes down to, at some point, the uranium market does need to prove that they can bring supply in, because you're right, it may get to the point where utilities just go, this is too hard. But I look at the appetite for gigawatts of electricity, and that appetite is not a 3 to 5 year appetite. This is a 5 to 10 to 20 to 30 year appetite, and growing. And I look at, can the West meet that appetite on just gas and coal? Sure. If you can get turbines and gas, then, and there's plenty of companies now trying to respond to that. Then yeah, short term, you could probably meet that need. Does carbon stay relevant in electricity generation? If the answer is yes, then you can't meet that need. So nuclear has to be part of that longer term equation. And as I said, I think from the perspective of building the new capacity, the tech companies are almost seeing it as a challenge, because everybody's telling them that nuclear cannot be built on time and on budget, and it just cannot be done, and we cannot get better at it. And as I said, the tech industry is, priding themselves on it. It was 2 years ago, somebody told Elon you wouldn't be able to catch your rocket. Now he's pretty much catching his rockets. We've got vehicles trying to drive themselves. We've got costs coming down across that whole new world. And then you're kind of daring these tech companies to say, oh, but when it comes to nuclear, you won't be able to build it cheaper. And so I think what then happens, as I said, is governments and capital can actually solve problems eventually on mine supply, but it has to come to a breaking point first. It has to come to that point where, and look, the uranium guys are not doing themselves any favour. We saw Sprott almost run out of pounds in the market, 2 weeks ago, and we popped up to $83, and then suddenly, bang, 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 Sprott's getting filled in on 200,000, 350,000, 450,000. That wasn't just magical pounds that some trader found, because the traders were trying to do 25,000 pound clips in the weeks leading up to that. That was all of these developers who have got inventory trying to take advantage of an $83 price to be able to report a positive cash quarter. And I guarantee you, when they all file for whatever quarter this is, September quarter, or maybe they've delayed it in the December quarter, they all will sit there patting themselves on the back saying, look at us, we raised $22 million because we sold some pounds. So again, they're not helping themselves. So the utility goes, there's plenty of uranium around, see, because the price went back to 77. So yes, there is a risk. Very long way of saying there is a risk that if the sector doesn't pull its finger out and prove that it can find supply, either somebody else takes that away from them and just throws money and capital at it to get it done. I think there's less of a risk that the demand for electricity says nuclear is too hard. I think what they do is they turn around to the oil and gas industry or another industry and say, Exxon, get in there and bloody build these things, we're sick of mucking around with these old timers from, who got into uranium in 1972.
Well, let's see what happens there. But I think what we're saying, it's complicated out there, and maybe I think the people aren't exposed to this kind of critical energy, this strategic energy conversation. Maybe the easy way is to look at someone like Mr. Guy Keller and his Nuclear Energies Opportunities Fund,
That's
and
the
I guess the
way.
Global Natural Resource Fund, which must be flying at the moment, I suspect, with what's going on with all the other metals out there at the moment. You feeling good things for the rest of 25 and into 26?
Yeah, I mean, it's kind of history doesn't repeat, but it often rhymes. And I'm kind of looking back to that September 2023 period where things started running then, and we got $106. We ran from WNA in early September, stalled November, December, and I think the uranium ETF did about 20%. And everybody said that's enough, and then it kept going and doubled again. As I said, we're at these levels, and three things haven't happened. Utilities are nowhere near getting as involved as they need to be in uranium. They've certainly been active in conversion enrichment, but they're nowhere near as active as they need to be. And within that as well, you're seeing financial vehicles being empowered again. And once these developers stop feeding them inventory, it will move again. The second thing is the US government is still not committed anywhere near the sums of money that they said they're going to commit in the fuel cycle. We've still got this overhang of potentially the uranium reserve kicking back in again. And thirdly, the tech companies and data centers, they've so far been really lovely agreements, and they send these things to the moon, but that money hasn't flowed yet. So I kind of sit there and say, even if you get one of those, we're at a pretty elevated level to start, because we've kind of got here on empty, or not empty promises, but on non-funded promises and a bit of hot air and hype. And I kind of sit there and I say, wow, when the rubber hits the road, it's going to be a really interesting and aggressive move. And I think there's no reason. I mean, 2020, 2021, what we had 7 quarters back then after the COVID collapse in March 2020. Our fund had 7 quarters of proper returns as this sector was getting a heartbeat. And, there were plenty of investors that turned around after 2 quarters and said, this has run too far, we're not playing. And there was a handful of brave investors who shut their eyes and said, we believe the thematic, and made a stupid amount of money over those other quarters. And I kind of think we're here again, where people are saying, oh, it's run. I say, great, no problem. Whatever you got to sell, I'll buy that. What, up here? Sure. Because we haven't started. This is the thing, we haven't started. $80 is not a clearing price for uranium. The forward curve in the brokers, which almost every other commodity will look at and trade their future desires and wishes over, the forward curve is telling us that December 30 spot uranium with future uranium is $96. And we're looking at this term price where, maybe 10 or 15% of actual business gets done, because utilities have worked out if they leave term alone or do low price term, they ain't going to move, and then no one's going to panic. We saw a little bit of that around WNA. So, it's the games, the window dressing, all of that stuff, the selling of inventory, that all comes to a point where it can't continue anymore. As I said, so, I'm still of the belief that a lot of ducks are lining up. Of course, geopolitics, global macro, we're all susceptible to that. So if the NASDAQ decides to go on halve, then we've got a problem with the thematic in the short term. Is that opportunity? Sure. Is the NASDAQ halving because the demand for electricity from their new technologies going away, or is it just because it's overcooked in the short term? Those are the things you got to. But macros, macro is something that has been the bane of our existence as resource investors for 2 years, and finally looks like we're getting some proper investable fundamental thesis, and to be able to say, there's a reason for being here, and that's why we want to do it.
Guy Keller, as always, insightful. I look forward to maybe hooking up with you when I'm in Oz in 2 or 3 weeks. Appreciate your time today.
I said beer, but I think we need to find a good Aussie red.
I could sign up for that.
Okay, excellent.
Thank you.